This is Accounting 546, Accounting for Income Taxes. Topic, what is ASC 740? Hello everyone and welcome. This will be a relatively short presentation. Today we just want to do a very basic, general, high-level overview as to what ASC 740 is, just to give you a feel of what the class is going to be about, and just to level set and make sure we all understand the topic we're going to be getting into later in the class. So what is ASC 740? First, we just have to start with the Accounting Standards Codification, which is created by the FASB. Everyone here should know what the FASB is. They set all of the accounting standards for US GAAP, and probably all the way back to either intermediate accounting or principles of accounting. We've seen the FASB come up multiple times. Specifically, ASC 740 addresses the financial accounting and reporting for the effects of income taxes that result from an entity's activities during the current and preceding years. So main points here, ASC 740 is very specific to income taxes, and we are going to account for taxes from the current year. And then what a lot of people forget about is all of the preceding years as well. As long as those income taxes are in play, we need to account for those. So ASC 740, it establishes the standards of financial accounting, reporting, and disclosure for income taxes that are currently payable and for the tax consequences of all of the following. So we have revenues, expenses, gains, losses that are included in taxable income of an earlier or later year than the year in which they are recognized in financial income. So these are our temporary differences that create deferred tax assets and liabilities. ASC 740, we have standards for other events that create differences between tax bases of assets and liabilities, and their amounts for financial reporting. There's a lot of different things that could go in here. Main ones, I guess, would be permanent items. If you have an acquisition, if you have an error, those types of things are going to create differences between book and tax basis. And also we have standards for losses. A lot of the complications and a lot of the nuances in ASC 740 deal with losses, whether we're carrying them back, carrying them forward, if we can realize the losses, all of those things. And so just real quickly on the structure of ASC 740. So the Accounting Standards Codification, if you look, if you look right here, this is how the Accounting Standards Codification is organized for all the topics, not just ASC 740, but for all of them. And so it goes topic, subtopic, section, paragraph, subparagraph. A lot of people get the last three confused, where it's paragraph, subparagraph, and then section, or section, subsection. So we also want to keep in mind the structure, topic, subtopic, section, paragraph, subparagraph. And so I put just a general ASC 740 site here, just so you can see how it would play out. So here the site is ASC 740-10-15-2. This stands for, we have topic ASC 740, income taxes. We have subtopic 10, which is titled overall. Our section is 15, which is titled scope and scope exceptions. And we have paragraph 2. In this particular site, I didn't put a subparagraph in, but this is the general structure for ASC 740. So when you see sites throughout the semester or in other places, you'll know where to look in the codification. Okay, so the age-old question, why do we need ASC 740? Why does it exist? Well, ASC 740 comes about because there are differences between what we're doing for US GAAP and then what we're doing for tax purposes on our tax return. And so first bullet point there, all of our taxes for the tax returns are calculated based off of the Internal Revenue Code. Income for the financial statements, as we all know, is calculated based on US GAAP. Or if you're not reporting under US GAAP, it's either under IFRS or some sort of other local country GAAP. And so, as I mentioned a little bit ago, there are inherent differences between the Internal Revenue Code and GAAP. They are trying to accomplish different things. They have different incentives in the case of the tax code. And so your income that you're going to calculate under the Internal Revenue Code or under US GAAP is going to be different. These differences must be bridged in the financials somehow, and that is what ASC 740 does. A lot of these differences are temporary, and so what I mean by temporary is these differences are going to arise in one period and then reverse in another and eventually offset each other. So there's no permanent differences or lifetime differences between income and expense. However, that's not always the case, as we'll find out as we go through the class. So one thing to keep in mind, I see a lot of people get, I guess, lost, for lack of a better word, towards the middle and end of the semesters as to what we're trying to accomplish. One thing we always want to keep in the back of our minds and consider is that at the end of the day, ASC 740 is going to be reflective of what is recorded on the tax return. We may have certain adjustments up front to not record specifically what is on the tax return, but at the end of the day, if you let enough time pass, the income tax provision will reflect what was recorded on the tax return because it has to. Tax return reports taxes that you are paying, and you're not going to pay any more tax than what's reported on the tax return. And so, again, that's one thing to always keep in mind. If you're struggling, don't know what to record, don't know what kind of effect a certain item has on the payable or expense, I just always encourage people to think back to how the tax return works, what's going to be reflected on the tax return, and then how the tax return increases or decreases tax. And then a lot of times that helps. Determine what we need to record for our tax provision. There are various nuances in ASC 740, which again creates a need for it. This is not an all-inclusive list at all, but I did list a couple questions here as to things that are a little bit tricky in ASC 740 that require a little bit of additional thought in order to record the correct answer. So I'll just kind of read these off. What if an NOL is generated that cannot be carried back for a cash refund? How does that affect our provision? So we currently have a loss. Generally, your losses and your income is going to result in some sort of cash tax payment or refund right then and there. But if we have a loss, we're not getting a cash benefit right now. What do we do with that in our provision? For the second one, what if credits generated in the current year are subject to limitations? So again, we're generating credits and we can't use them this year. What do we do with them? And then the last one, how do you account for an item where tax is not due today but will be due in the future? This is getting to our deferreds and our differences between book and tax. Okay, so now that we have talked about what ASC 740 is, why we need it, let's talk a little bit about scope. So scope is essentially what falls under the jurisdiction of ASC 740. This topic applies to all entities preparing financial statements in accordance with US GAAP. This is going to include domestic and foreign entities, including not-for-profit entities. I have all highlighted in red there because ASC 740 does apply to all entities. If there is a financial statement prepared and issued under US GAAP, Accounting Standards Codification Topic 740 applies to those financial statements. There may not be any calculations necessary, depending on what kind of structure the entity is. However, the rules of ASC 740 do apply. So when you're out there in practice after you graduate, or either right now as you're working, whenever you see some financials, even if it's not obvious that it would apply. So ASC 740 is going to include guidance for taxes based on income. Right here, taxes based on income. This is going to apply to any sort of tax based on income, federal, state, local, and foreign. The nuance and the tricky part with ASC 740 is that the code doesn't specifically define taxes based on income. So we're sitting here wondering, what kind of taxes do we need to account for under ASC 740? The only guidance that the codification gives is it defines taxable income. And that is defined as the excess of taxable revenues over tax-deductible expenses and exemptions for the year as defined by the government authority. So the main thing here is that we have revenues minus expenses. That's going to be the main piece to tell us if a tax is going to be a tax based on income or not. Although similar, taxable income as defined under ASC 740 is and can be very different from the federal taxable income that we'll be calculating in class. As we go through class, we will have a lot of activities, a lot of calculations with a what's known as a book to tax calculation. And the further and further we get away from the scope section, and the more and more we calculate either federal taxable income or state taxable income or a foreign jurisdiction taxable income. When I ask the question later, how does ASC 740 define taxable income? A lot of people forget that it's the basic definition of excess taxable revenues minus tax deductible expenses. One thing I guess that's kind of interesting is that in order for a tax to be an income tax under ASC 740, so it's tax based on income, it does not have to be all of the revenues and expenses of a particular entity. And so you can have a subset of revenues and expenses and have the tax qualify to be a tax accounted for under ASC 740. So for example, an easy one might be the state of Texas. Texas takes your revenue, they subtract out cost of goods sold, and then that's your tax base for the state. And so technically, that meets this definition here of taxable income. We have some sort of revenue, some sort of expenses, and we subtract the two, or we subtract one from the other, and the net piece is the piece that's subject to tax. So again, it doesn't have to be all of the revenues and expenses of an entity. It can be a subset. The last bullet point here, taxes solely based on gross receipts or some sort of other metric that's not revenues minus expenses is not accounted for under ASC 740. There's a lot of misconception out there, and a lot of people do it wrong, where any sort of tax assessed by a jurisdiction that a tax return is filed for, a lot of people think that all of those taxes are going to be accounted for under ASC 740. And quite simply, it's just not true. There are some taxes out there that are filed on tax returns that technically should not be under the scope of ASC 740 and should be accounted for under a different topic in the codification. There's not a ton. It used to be a lot bigger issue, I think, back in the day than it is now. But if you see a tax come up that's solely based on gross receipts and there's no component of revenues minus expenses, it's not going to be a tax accounted for under ASC 740, and it should not be in the income tax provision. Next up, credits. So non-refundable tax credits are going to be included in the scope of AC 740, while refundable tax credits are not. This is one that I see probably every year. I see a couple clients mess up on the application of credits. Only non-refundable tax credits are going to be included in AC 740, while any sort of refundable tax credit is not. And again, even if this credit is claimed on a tax return, if it is a refundable credit, it should not be included in the tax provision. The last bullet point there, the theory as to why refundable tax credits aren't included in AC 740 is that it represents more of a government grant or subsidy as opposed to any sort of reduction in tax. We care about scope and we want to get the correct taxes in the scope of AC 740 and the incorrect taxes out of AC 740, because accounting for an income tax versus accounting for any sort of other tax, like a payroll tax, a sales tax, they are extremely different. There's a lot of work that goes into an AC 740 income tax calculation that isn't necessarily there if you have a different type of tax. And so getting the scope correctly can dramatically change, one, the results of the accounting, but two, the amount of work that goes into it. So having said this and kind of said my spiel on getting the taxes correct based on scope and if you have a tax based on income and all that stuff, I will tell you a lot of people include taxes in ASC 740 that shouldn't be there and they know they shouldn't be there. This essentially comes down to materiality. So if I'm a company and I pay millions and millions of dollars of tax and I have one tax, it's like it's not going to be a tax based on income and it comes out to $500. A lot of people will just throw that tax into the tax provision, mainly due to usually the tax director or the tax department is going to be the owner or in charge of that tax. And so if they just include it in the income tax provision, it more easily reconciles to some of their schedules and some of the taxes that they are in charge of. So we want to know the rules, we want to get it right, but if you see a tax provision out there where they have some small taxes that technically don't fall under ASC 740, but they're being included in the calculation, before you go ringing alarm bells and kind of telling people it needs to change, you want to assess materiality first, because a lot of people do include some taxes in their tax provision that shouldn't be there. All right, to continue here on scope, AC 740 has 4 taxes directly from the codification that it excludes, or it says AC 740 specifically does not apply to these. First one is going to be a franchise tax to the extent it is based on capital. For those who don't know what capital is, it's essentially your equity in the business, I guess, to keep it simple. If you have a tax based on capital, it's generally not going to be calculated based off of some sort of revenues minus expenses. So therefore, it's not a tax based on income. The next bullet point down right here, although taxes in excess of a minimum tax based on capital is within AC 740 scope. So some states, you get a lot of states that will assess some sort of capital tax, either in lieu of an income tax or in addition to. Some states will have you calculate your tax 2 or 3 different ways and then make you pay the higher of the two. So the state that's coming to mind for me right there is New York. New York will make you calculate your tax 3 different ways. One is going to be based off your straight income, taxable revenues minus taxable expenses. The next way is they're going to calculate some sort of gross receipts tax where they take your income and multiply it by some sort of rate, and then they are going to calculate a capital tax. It basically says take your equity, excuse me, take your equity and multiply it by some sort of rate, and then that is your tax. And then once you calculate your 3 taxes, New York says, well, pay the higher of the 3. And so how that weaves into ASC 740 is that the capital tax may be considered some sort of minimum tax, where if your capital tax comes out to $1,000 and then your income tax comes out to $1,500, that first $1,000 for the minimum tax based on capital is not going to be included in ASC 740, while the $500 above that will be included in ASC 740. I don't know that we'll get into that kind of minutia here in this class, but again, that's what this section is trying to get at. Next one that doesn't apply is a withholding tax for the benefit of the recipients of a dividend if the tax is payable by the entity, if and only if the dividend is paid, and shareholders receiving the dividend are entitled to tax credit for the amount withheld. So essentially what it's saying is withholding is not going to be included in the scope of ASC 740. That's someone else's tax liability and shouldn't be represented as the company's tax liability. For those who don't know what withholding tax is, you want to think about your paychecks. So when you get a paycheck every week, the company, or if you work for the university is going to withhold tax from your check and deposit the net amount into your account. So if you make $1,000 for the week, the company is going to withhold, I don't know, $100 of income tax, $50 of payroll tax, and so you made $1,000. They withheld $150 of tax, and then they will deposit the net amount, $850, into your bank account. That's how withholding works. And then specific here, a lot of times when a company pays a dividend, the government's going to want their money up front, especially if the person receiving the dividend either doesn't reside in the country or the state and they don't file a tax return there. Government wants their money up front. Then if they're not subject to tax for whatever reason, or their tax liability comes out lower than what the withholding is, then they can file a tax return and get their money back. But to round it out, withholding tax is not going to be included in the scope of ASC 740. We kind of talked about this next one a little bit on the previous slide. If you have a tax solely based on gross receipts, revenue, or capital or equity, that tax is not going to be under the scope of ASC 740. Then if you have a tax in lieu of an income tax, that is not going to be in the scope of ASC 740. Some states will assess a tax and then they'll write in the code, this is in lieu of an income tax. That by itself is not going to make it a tax that we're going to account for under ASC 740. Again, just because it says in lieu of an income tax, we can't say, well, this is supposed to be an income tax, so we're going to include it. We just have to go back to the rules in the previous slide, and we have to go through the whole revenues minus expenses, tax based on income rules to see if it applies. Okay, and then taxes also do not apply, or ASC 740 doesn't apply to all taxes. Again, briefly mentioned this before, but any sort of sales and use tax, property tax, payroll tax, excise tax, VAT tax, capital taxes, those are not going to be included in the income tax provision. Again, scope is important because classification is very important under US GAAP. So what I've seen in my career thus far is that if an item is supposed to be a current asset, then we should list it as a current asset. It shouldn't be non-current. Same with the liabilities. If an item is revenue as opposed to expense, it should be listed as a revenue. Same type of thing holds here. If a tax is subject to AC 740, it should be reported as such. And if it's not a tax under AC 740, then it shouldn't be reported as such. This helps with comparability with different companies. If companies are accounting for items however they want, or they're applying different rules, it helps, or it doesn't help with comparability between companies if we're trying to assess a company's tax efficiency versus another in a particular industry. Another reason why scope is important is that I've seen it quite a bit more, actually more than I would have thought. But a lot of internal metrics are based on income before tax or pre-tax book income. And so, if you have a company where their employee bonuses are based on pre-tax book income, they may be very focused on that pre-tax book income number. They may care a little bit less about the income tax expense line, especially if you have ideas as to lower their tax. I had one client where, gosh, we were trying to save them a couple $100,000 in tax, and it was going to cost them somewhere between 30 and 50,000 for us to do the work. And even though it was going to be a net benefit, the controller basically told us no, because his pre-tax book income was going to go down, and then the internal metrics that he's evaluated on were going to decrease, and then his bonus was going to be lower, or something like that, as to a specific reason why he didn't want to do it. So again, if we're trying to move a tax either up into pre-tax book income because it shouldn't be under the scope of AC 740, or if we're trying to move a tax down, we always kind of want to be thinking about these things because clients are thinking about them, and then it does matter if a tax is subject to AC 740 or not to get the classification correct. Okay, so our objectives of AC 740. Primary objective is to reflect the after-tax financial position in the balance sheet. This is one of those that you want to remember and think about kind of throughout the semester. What am I trying to do? What am I trying to do? What's the overall goal with the provision? Where do I want to end up? The thing that I always come back to pretty much every day when I'm working is trying to reflect this after-tax financial position in the balance sheet, which in the next presentation we'll have an example that goes through that. The biggest piece here, and if there's one thing you remember from the presentation today, is that the balance sheet method is used to accomplish the objectives of AC 740. Balance sheet method, balance sheet method. The idea with the balance sheet method is laid out down here. This is, for lack of a better word, a tax account roll forward. We will be doing a lot of these in class where it kind of lays out all of the different tax accounts. The idea here is that your current tax payable or receivable, your deferred tax asset or liability, then your unrecognized tax benefits. These are all balance sheet accounts. And then as it says down here, if you get the balance sheet correct, then the income statement falls out. And our income statement accounts are current, deferred, and then other. What that means essentially is everything we're trying to calculate in ASC 740 is balance sheet related. So we're concentrating on calculating the tax payable. We're concentrating on calculating our deferred tax asset or deferred tax liability. Once we have those two things calculated, our income tax expense on the income statement is going to be calculated for us. So again, once we calculate the balance sheet, then the income statement falls out. I think one thing that's fairly obvious is that our taxes are not recognized on an as paid basis under US GAAP. So if we remember all the way back to intermediate accounting or principles of accounting, we have the accrual method of accounting, which US GAAP uses. Income taxes are no exception to that. And the cash method is not used when accounting for taxes under ASC 740. Some more basic principles here that we will want to remember as we go through the class. I have these, not in this presentation. I think when we start to talk about the steps to accounting for income taxes, these basic principles are going to be on the bottom of those steps. These are things you always want to keep in mind as you're accounting for your income tax provision and just trying to take a step back and say, is what I'm calculating making sense? So again, we want to calculate for all items that have been recognized in the financial statements. We need to account for our current tax liability or asset if we have some sort of refund or receivable, for all of the current tax returns and prior tax returns if we're waiting on a refund from the government, or if we're filing an amended return. Those are going to be prior year tax returns. Once we calculate our current tax liability, then we need to calculate our deferreds. And so if we have items that are going to be recognized for book and tax at different points in time in the future, it is going to generate this deferred tax impact. And we need to calculate for our DTLs and DTAs in accordance with those rules. Once we've calculated our payable, once we've calculated our differences, we need to measure those deferred assets and liabilities based on the enacted tax law. Main thing here is that we're not supposed to anticipate changes in tax law. So if the tax rate next year is going to change, it's either going to increase or decrease by a certain percentage, we're not supposed to take that into account when calculating our current DTAs and DTLs. Now this bullet point is getting into UTPs. All of the assets and liabilities and expense in our financials should be on a more likely than not basis. We will get more into that as we go throughout the semester. Last bullet point here is talking about valuation allowances, which again we'll get into a little bit later. But any sort of DTAs that we have, we need to reduce them if we don't think we're going to realize the benefits of those assets. So these are the basic principles that I put together. As you're doing activities, I'd encourage you to take a read back through these principles just to see if you can see them in the activities and to make sure that what you're calculating is correct. Another item here real quickly is our income tax equation. Right on top here, we have total income tax expense. That's the expense item that goes on the face of the financials. That's going to be made up of three different, subtypes of expense. One's going to be your current tax expense, deferred tax expense, and then other tax expense. Depending on what you're looking at, depending on the person, where they went to school, or who they worked for at the beginning of their career, some people use this other tax expense, item. Other people just lump it into current tax expense. For the most part, I see people lump other tax expense into current tax expense. I'm not sure it's a huge deal. Technically, it's incorrect to do that, and we have this third kind of expense here for other tax expense, but we'll get more into that later in the class. But to define them really quickly, current tax expense should be the taxes expected to be reflected on the current year tax return. Our deferred tax expense is going to be the change in deferreds. From a general standpoint, that's not always true, but for the most part, 95% of the time, that's going to get you there. One thing to know about deferred tax expense is it has It has an inverse relationship with DTAs. So as my deferred tax asset increases, my deferred tax expense is going to decrease, and then vice versa. As my deferred tax asset decreases, my deferred tax expense is going to increase. It's the opposite for deferred tax liabilities. So as my DTL increases, so does my deferred tax expense. And as my DTL decreases, so does my deferred tax expense. For the other tax expense, generally that's going to be defined as your expense related to or your changes in your unrecognized tax benefits. We will get into this when we talk more about uncertain tax positions later in the class. Again, technically the correct way is to break out the expense associated with your UTBs. In practice, a lot of people lump the other tax expense into current, and it works just fine. I tend to calculate everything separately just so I can more easily keep track of all the different items, and then either lump or aggregate or summarize maybe a little bit differently when reporting for financial statements, but at least in the work papers you have the item broken out so it's more easy to tell where it's from.